Good afternoon, folks. While we wait for people to trickle in and read some disclosures to get things out of the way, hope everyone's having a nice Tuesday. We got CPI tomorrow morning before the open. Biggest data point I think that we've been waiting for since the jobs report this past week. And really should get PLBY's results, PLBY Group's results any minute now. But I'll wait, see if we get a few more folks to join before I read a disclosure and then open up the discussion. It's 4:01 Eastern Time, Tuesday, August 9th. Not seeing it yet on the company website. Expect that they will likely have it out any minute now. Righty then. So, I kind of intend for this to be an open discussion. If anyone wants to opine at any point, welcome to come up. If people want to stay up as a speaker and be part of the conversation, they're welcome to. I'll just share some additional information as we get a little further along. But yeah, I've got about a dozen in here to start. So let me go ahead then and just get a disclaimer out of the way. Obviously, this is Rod. This is Rod Alsman. I'm the managing director at Wook Capital, and I'm posting this under the Wook Capital account. So I think that we're probably not reaching as broad of an audience as if I were hosting it on my personal account, but do need to make sure that folks are aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. And just for those who are unaware and may be unfamiliar, Wook Capital is newly founded this year. We are really a direct byproduct of the crowdsourced research that went into the 2020, I guess you could call it GameStop investment thesis. We have goals of collaborating with retail investors to crowdsource equity research, uncover overlooked information, and to develop actionable insights and fill in the blanks together to realize long-term outperformance. So we've really just gotten underway. We have a lot more coming down the pike shortly. I'm very excited about that, but I won't go into that. It's 4:04. Don't know if anyone has yet seen. If anyone does see the information out, please come up and share. But with that all said, we're going to really just review, I guess, both the current earnings for the second quarter as when they come out. Company's going to host their call at 5, a little less than an hour, I assume. And we can talk about where the company's today, where folks think they're going in the near and longer term future. I have personally been invested since first quarter of 2021, and Wook's, you can see on Wook's Twitter a disclosure that Wook went long the stock in late 2021 as well. So I see a lot of good participants in the audience, folks who I know have been following the name closely, and I certainly don't want to put anyone on the spot. You're all welcome to request to be a speaker and be part of the roundtable kind of open discussion. I really don't want to hog the floor. I have my own opinions. I'm happy to share those. And yeah, I know that I got Maven Fund in here. Buddy, Barker, know you, both of you have done plenty on this one. And yeah, still on the company site, not seeing that the earnings are up just yet. Ah, there we go. They're out. Okay, so highlights: revenue at 65.4 million. That sounds like a miss. I believe consensus. Let me pull up Cap IQ consensus estimates. Cap IQ consensus was just shy of 71 million, so 65 for if I can do my math correctly, that's just shy of a 10% miss, 9% miss on revenue. The EBITDA loss was 2.6 million versus consensus had a 3 million EBITDA gain. Net loss 8.3, which was a little bit worse than consensus of 6.6 million. They're highlighting that licensing revenue was flat year over year at 15.9 million. Let me go ahead and just tweet while I'm logged into my personal account on the computer. Let me tweet the links so that we can have it easily accessible for folks who join the call at a later point in time. And we can kind of go through that. Folks who are trying to actually read the details, if you've been able to read through them, you're welcome to come up and share what you're seeing, and we can foster the discussion. Dick Butt, I see you've come up. You're welcome to chime in. Let's keep it on topic.
Yeah, I just wanted to say that the results were out, but you found it.
Oh, thank you. Yep.
My biggest issue with earnings was the stock-based compensation. It was only 4.7 million. It should have been higher for all the hard work they've done.
Yeah, we can talk about stock-based compensation. There's definitely. Sorry, I can't multitask very well. I am looking to pin the tweet I just made on my personal account. But yes, anyone who wants to come up and speak, opine on earnings. It looks like a rough quarter. I'm looking and actually just now reading Ben Cohen's comments, so I'll just verbalize it. Quote, the macro environment is posing many challenges. However, we are encouraged by continued growth at Playboy and Honey Birdette, along with the recent creator success we are seeing on Centerfold. As headwinds increased, we pivoted quickly, reducing non-core costs while remaining focused on our long-term plan to build out our ecosystem, leveraging the strength of our Playboy brand. So that's really it from the release and those brief financial highlights that I had read off just before. Looking like SG&A was again up massively year over year. We've got, let's see, we've got 46.6 million shares on a weighted average. I don't see in the release. I guess we'll have to wait for the K to see what the current shares outstanding are as the dilution continues. And we'll likely in the Q get some information on where those shares are going towards. If they are paying creators in shares, we know that Cardi B was paid in shares in the fourth quarter of 2021. We've yet to see anything from her other than a few Centerfold presentations, although the 8-month ago PR indicated there would be product collaborations. I've not yet seen any of those. Looks like there's another fair value remeasure that's impacting reported EBITDA. So their adjusted EBITDA is negative 2.6. So, and then, yeah, another, as Dick Butt noted, on stock-based compensation, another 4.7 million in stock-based compensation in the quarter. So year to date, we're now at 11.3 million in stock-based comp on what looks like 134.8 million. So about 9% of revenues are in the form of stock-based comp year to date. So that's a recurring issue that I'm sure that folks have thoughts on. We know that there were significant one-time share-based compensation rewards granted in the fourth quarter of 21 on the back of their 2021 incentive plan vesting structure. We can talk about that if we want, but yeah, in terms of second quarter earnings themselves, they look pretty meh. However, I'm seeing the stock is pretty flat from what I'm seeing in TD Ameritrade. It looks like it, had closed, I thought, at just around 7, and it looks like it's only trading off a nickel right now, give or take. So largely a muted reaction so far. The market must have priced in, presumably, a miss, right? And we did have a modest miss. So really, again, there's not actually much detail on what the company has provided. I can share some information that I've shared in the Playboy Investor Discord, some of the order trends that had been observed. I've not gotten any updates quarter to date on the side of Honey Burdett, but some of you that have been closely following the company may have seen that as of July 1st, they began to discount heavily on Playboy.com. There was an up to 70% off sale. That did lead to a commensurate increase in order volumes for third quarter to date. If I can find the exact data point, I'll share it. Yeah, I'm going to shut up. Let anybody else who wants to come on up and share their initial thoughts. Obviously, we've got now about 50 minutes till the call kicks off, and depending on how this is going, I am open to keeping this open while the call is going on. I do have a Cap IQ subscription. I may just open up the live transcription if that's going on. Otherwise, yeah, let's see how this shakes out. But everybody's pretty shy so far, so let's see. But for now, I'm just going to pull up the Playboy order tracking data that I have. I've mentioned this, I think, multiple times in the investor Discord. Their order numbers are sequential for both Playboy.com. Honey Burdett has 3 separate regions. They have Australia, which includes all of Asia. They have UK, which is all of Europe, and US, which is all of North America. So you can track their order number cadence from a gross order basis and apply whatever adjustments in terms of expected returns, et cetera, order average to kind of come up with some ballpark figures on their e-commerce operation. They noted continued growth in Playboy and Honey Burdett in their very brief statement, but in this particular way in which they report in the release, there's no breakout of the segments, so it's really difficult to have much to talk about. But I will say, for Playboy.com, there was about 556 orders per day in the second quarter of 2022. That compares favorably with the second quarter of 2021. That in fact is about 60% higher year over year. Now, Playboy.com, for those of you who have been following the company closely, probably know all of this, but for those of you who are less acquainted, Playboy.com, it had been more of an entertainment site until 2020. They shifted it into a e-commerce destination for purchasing apparel and accessories and other. So really, the Playboy.com base is very low. In 2019, it was 0. 2020, it was quite low. 2021, it began to ramp. So from 2Q22 versus 2Q21, just gross order numbers, they were up about 61% from the crowdsourced data that I have. Now, 3Q for the month of July, the last data point I have is for July 30th, but as I noted, they had that aggressive discounting going on, and that 3Q versus 2Q sequential cadence is up from 556 to 1,000 orders per day. So it's about an 80% increase. So clearly the discounting lever has seen some success in driving incremental volume. on the back of that promotion, I did see that Honey Birdette was also running some promotions. However, I have less data on Honey Birdette. But I will say with Honey Birdette, the data I do have show that, for example, this is a very obviously low-ish volume, website relative to your big e-commerce players. Like on the Australian order numbers side, they were averaging about 330 daily orders in the second quarter. On the US side, do the math real quick for us. I believe it was comparable. Yeah, it was pretty comparable on the US side, and I don't have enough data for Europe to share, but and I don't have enough historical data. Obviously, Playboy purchased Honey Birdette last year I know they announced it at the end of June. If I'm remembering correctly, they closed in the third quarter. So I unfortunately don't have year-over-year comps on Honey Birdette, but there was a bump intra-quarter. Honey Birdette ran promotions in the last month of the quarter, and similar to Playboy.com, there was a significant increase. In their case, it was anywhere from 60 to 70% bump for the month of June versus the first 2 months of the second quarter run rate. So again, that there's clearly demand for the product, and they do have levers to pull, but the question mark then becomes the cost side of things. And I think that's where, when we see 65 million in revenue and 41 million in SG&A, when you look at net revenue and just cost of sales SG&A, you're already negative on the operating line. So clearly the company mentioned in the preceding quarter call that they cut some headcount, so there may be some termination in there. And I don't see in the reconciliation that they've made any adjustment on the EBITDA line for anything like that. But yeah, there's really not too much else that I can add on the 2Q results. Overall, pretty lackluster. Anyone want to come up and ask any questions or share any thoughts that they're seeing on their side of things?
I hope most of the SG&A was on Centerfold spend.
Yeah, Centerfold. That's yeah. Well, I'm sure we'll get some more commentary from the company in 40 minutes on their Centerfold initiative. They did remark, of course, that they're seeing recent creator success on Centerfold, whatever creator success means. The one creator that is in the Playboy investor Discord has remarked that she's not yet seen any traction really on paid transactions relative to her other platforms. So there's just really not much out there. The company's yet to provide any sort of daily, monthly active users, any sort of context. Obviously, they've guided that it will be immaterial for 2022. It certainly appears it will be immaterial for 2022. The question then becomes, at what point, given their we don't have a balance sheet to look at. Obviously, they should have had some favorable working capital benefit from the Chinese remittances come twice a year. So Lance Barton, the CFO, had noted in the preceding quarter that just simply due to timing, they expected that in the second quarter. Again, there's just not much that they have actually shared with us in this brief blurb. But Liren, buddy, hey guys, please shut me up.
Hey guys, hey Rod, thank you for hosting the space. And just wanted to throw in the air a thought. What do you think, guys, about, as you said, Rod, 60% growth in order numbers year to date from year over year, for the quarter, but given the massive discount how do you look at this? Is it impressive, like 60% growth, but with 70% discount? Okay, that's all. If you have any thoughts, we'll be glad to hear. Thank you.
Yeah, so just to clarify, the year-over-year Playboy.com order number growth was 60%. The quarter to date, which is really just the month of July, I have a data point from July 1st and through July 30th. That reflects about an 80% sequential daily increase versus the second quarter, compared to the third quarter of 21, which I'm talking about 30 days under heavily discounted conditions. But that 1,000 orders per day compares favorably to 409 per day, which is not a full quarter data point. I don't have the starting and ending, so it's an intra-quarter data point. But it obviously is more than 100% year over year increase if we were to see continuation of that trend for the third quarter. But then, of course, the question mark becomes with increased costs of shipping. I know the company has increased its minimum for free shipping on Honey Birdette from 100 to, I believe they raised it to 150 within the second quarter. I'm going to actually just go on the site and double check that real quick. On the Playboy side, I believe it is still $100 minimum order. So the average order value is around that, based on the comments that the company's made in the past. It's entirely possible it may have trickled up a little bit from the 100 mark, but yeah, I mean, look, it's good, obviously, to see growth. It's good to see growth in the top line, but I'm not seeing any operating leverage in this business. Now, to be fair to the company, they've discussed that they're running, really a variety of duplicative ERPs on all of the businesses that they acquired over the course of 20 and 21. So there's a lot of, let's call it mid-single digit million, maybe, in duplicative cost baked into their model right now. That Wook had met with Lance earlier this year, and the message from Lance was, that they're obviously working to resolve, the ERP transformation ASAP. However, if they're unable to complete that by, Halloween, which costume sales are a significant part of their business, they're going to, kind of put that on pause until early, 23. They'll come back to it after Valentine's Day, since Halloween to Valentine's is kind of peak season for them. So my personal expectation had always been they wouldn't complete the ERP transformation until at least first or second quarter 23, simply based on what I've observed in my time when I worked at Ryder System. Actually, they had done an ERP, and they tend to take at least 12 to 18 months and possibly more. And then I obviously have no unique insight into Playboy situation other than what I just relayed about. They're not going to be doing the work in the midst of their busiest season, so they may get it done. I'm sure there may be comments from the company on that in 35 minutes, but yeah, hopefully that's some helpful information.
Yeah, thank you, Rod.
What's up, buddy?
Not much. How you doing?
Man, I've been better. I was owner of another company that had a very rough day, down 45% in the energy space. So, flattish to down is okay on the PLBY side. This is down now. Now it's down to 675 is what I'm seeing, the latest tick. So it's declining a little bit as after hours continues.
Yeah, no, to be quite honest, I was expecting a lot worse today as well. Still not happy with the financials. The two things for me, you mentioned the operating leverage there. Like, for me to get optimistic again, definitely have to see that improve. And then the stock-based compensation is insane to me. I don't like with the stock performing that way it is. Like, I can only imagine what that number is going to be if the stock was performing strongly.
Yeah, I'm really confused about it because I had seen information relayed from, I guess, an interview or a discussion that Hedgeye's analysts had with PLBY management and the CFO had indicated to expect a 2 to 4% of revenues SBC in terms of a normalized level. So it's confusing to me why we're seeing SBC still at nosebleed levels, and like you noted, at these share prices, it's just especially painful. So yeah, second that.
Maybe they're adjusting for inflation. They're trying to take care of their employees. Other companies should follow suit.
Yeah, I actually just tweeted at the PLBY CEO. I'm going to be looking for a position there soon.
I've heard good things from the folks who visited the office. That they have a lot of art and other assets that maybe they could decide to monetize those instead of this continued dilution. But yeah, again, it's hard to know, right? The assumption here is that they didn't use any of the buyback that they had authorized in the midst of the quarter, right? I assume they would have remarked on that. They didn't. However, we've yet to see the queue, so I don't want to say they certainly didn't perform any buybacks, but my hunch is that they did not. Which beggars the question: what again was that just simply a predatory capital raise because the cash situation is even more challenged than maybe observers had thought? Right? They raised $25 million, up to 50 is what they can tap on a preferred capital raise that had pretty expensive cost, and they authorized up to 50 million share repurchase. So yeah, obviously it could be used for general working capital, general corporate purposes. But it just raises the question of why are these costs so high? Why are we not seeing any form of operating leverage? Why are you paying yourselves so much in SBC when we're just really not seeing commensurate acceleration on the top line? Now, look, obviously they're reporting that direct-to-consumer revenue grew 59% year over year, but that also accounts for the fact that they bought Honey Birdette. And so if we were to look at organic revenue growth, which they're not disclosing in the release they had, it's meaningfully lower than that. And obviously with licensing revenue flat year over year, that's just not part of the growth story. So disappointing, I think, results, right? All in all, the stock is continuing to trade down now. The last tick I see is 660, and it looks like the bid ask is 650, 660. So it depending on what management says in the next half hour here, it could continue to trade down overnight or in later part of after hours. But obviously none of us know what's going to happen in the short term with the stock price. It is worth noting, obviously, that the brand awareness, I don't think I've heard of any diminishment in terms of brand awareness. I know during the quarter I went to several retailers, Tilly's, PacSun, just kind of anecdotals, trying to get ask people questions, seeing people in the store, perusing PLBY apparel. I think broadly the data I've seen from both those anecdotals and also from survey data I saw in the fourth quarter is that the perception of the brand is pretty actually positive from their target consumer, which is your Gen Z, your Zoomer, or maybe millennial. And they've in the past discussed the mix of their purchases coming from under 34 being the bulk of their e-commerce direct to consumer activity. And clearly though there's those consumers are somewhat strapped, and we still have the question mark of will student loan repayments get pushed out again, because I think it's safe to assume that demographic has a significant portion of, I guess you could call it fake discretionary income right now that is in the form of deferred payments that they may not be saving and are instead spending. But that's a little bit of me just positing. I don't have hard data to go off that. But Mr. DCC, sir, how are you?
Good. How are you doing there, Rod? I think it's
always fun.
I think it's clear that their stock-based compensation contracts are set up based on USD value, not the share price. So as the share goes down, then dilution goes up, I guess. And then I can only imagine that their nonstop flights to Jackson Hole are one of the large reasons that SG&A is just through the roof. I mean, it's terrible. you would think that a company that has the CEO and the chair of the board both have huge ownership stakes would actually care about costs. But it's clearly not the case for the culture of the company. And I think when they let off their release, the first quote, the macro environment's posing many challenges. I mean, that's terrible when you hear that as the first line. And then their non-core costs that they reduce, it's not actually clear what costs they reduce, because outside of maybe outsourcing their NFT team, which really the surprising thing is they still have moderators on their NFT Discord that are paid for basically an abandoned project that they're most likely at this point only keeping alive to prevent any kind of FTC investigations that we saw with other NFT projects. So it seems like they can't find any way to operate smartly as a business, which is a shame because they have really good IP, but they can't seem to make a decent decision. And I think that's the saddest situation you can have here. Everything is just about how can we expense ourselves and our lifestyle at the expense of the shareholder. It's just like, I remember when I first came into the name, which probably was around April 21, and the talk was, okay, let's refinance the debt, let's get it at a lower rate, and they had a cleaner balance sheet at the time. It's just gotten worse. Like it just gets worse and worse, and they were lucky that they had positive net income last quarter, but I don't see why. Like Q4 is supposed to be their strongest quarter with costume sales, so then why was Q1 so much better, but then Q2 jumps back down to a loss? I mean, they don't have a way.
We got Valentine's in Q1.
Yeah, but I don't like. I just they have, and I think some of the bull thesis here is actually potential bear thesis. So, for example, if you go into a mall, they've got over half of the PacSun stores all Playboy clothing. So what happens when PacSun decides to not do that, right? And what happens when they lose those kinds of things? It's hard to get much more saturated at the mall than what they're at right now. When I went by, Spencer's had the giant Playboy logo in the window, but they only had piercings. They didn't have any other content, and that's probably some issue with PacSun license that prevents Spencer's from carrying Playboy clothing. So it's like, on the other hand, they've got really good penetration among the youth. How can that penetration get any better? Like I haven't seen any of their flywheel actually work. The centerfold is just an utter disappointment, and it's clear that they got into something that they should never have gotten into. Outside of the legal risks of hosting, user-generated content, they don't even know how to monetize the legitimate content. It's just.
Yeah, I think Centerfold, I know we talked about it a little bit in the Discord. I think it was within the last few weeks, but maybe you could speak to what was uncovered with regard to the I guess the white label product it appears that they purchased, which is speculative by nature, but it does appear that whatever it was they spent $30 million in equity on, and for Dream.me, look, that appears misplaced. So let me let DCC, if you can kind of respond to that. Jimmy, I'm going to let you get in on a second, but I want to address the NFT point. So obviously we only have an income statement here, so there's going to be a non-cash expense for the depreciation of the Ethereum they hold on their balance sheet. So again, until we get the cash flow statement, we don't know, whether they did generate cash in the quarter or how much it was. Obviously, I mentioned the working capital benefit that they should be seeing from the Chinese licensing. I think from a trying to look with rose-colored glasses, the good thing is that those payments came through, it seems, which I know was a concern I heard voiced from at least one shareholder with a with a 6-digit share count. So that's obviously good that it appears they're being paid by China, and there is of course noise on some of these non-cash expense items in this P&L. But to your point, where the centerfold is clearly, it has been a failure to date, and I know you've been watching it quite closely and have gleaned some data, and none of the data that I've seen is attractive in showing that they're making progress incrementally. Obviously, they highlighted in the comment that they're bringing some more creators on board. I mean, it's coming up on 9 months now, and this process appears to still be fully manual, and there's still a extraordinarily limited number of creators that have been added to the platform. I've heard various anecdotals about people who have friends or acquaintances who've requested to join and have not heard a response with months and months going by. So look, there's all this expense, but what are people actually working on? It's kind of baffling as well. So maybe DCC, if you could maybe respond to some of that, and then I'll get to Jimmy, and then I'll go to Buddy.
Yeah, so there was I think a lot of this is really unconfirmed, and so I'll put an asterisk on it. But there was a post on this website called Scrile Connect that it was titled "How to Make $30 Million Using Our Platform" or something, and the post talked about that you could white label their thing, and it talked about PLBY buying Dream, and it there's that post has since been deleted. So I think I think,
and it was deleted after it was posted in the investor Discord.
Yeah, that right. That was deleted after. That was a post on Twitter that you're referring to. There was actually a blog post on the Scrile website that gave a little more detail, but that was deleted. But that was deleted before the investor Discord had seen it. But the tweet was also deleted after it was posted to the investor Discord, which is very uncanny because it was an old, over a year old tweet. So it was weird that the rest of the tweets on the account stayed open, but this one that mentioned Dream. So there's a feeling that there's somebody watching the Discord who saw that and said that needs to get deleted. Now, why? We don't know. There's hypothetically that this company is wrongly using Dream assets, and the company says you need to take that down. You can make your own decision on there. But I think that, curiously, we heard mentions on the investor Discord that Mike Dow is no longer at PLBY, that I think that both Mikes are gone. So if acquiring, and by the way, like when the acquisition was first announced, Ben talked about we have like 50 developers. We were working with this group. I don't remember the name off the top of my head, but we're working with this group, which was like basically an outsourced group, to build out the features. We haven't really seen much come through. There are software engineers that are in the investor Discord, and what they're seeing, it's like there are parts of the development of Centerfold that look promising, but they stay as parts, and you never actually see any vision. Like live streaming came, but there was no addition to like find out when anybody went live and the notifications there. There was an update to like the profile page, but there was never any updates to the rest of the site. Katie on the investor Discord mentioned that the accounts on the Discover page have not changed from day one, and that was supposed to be something like that would have helped users organically find new creators. Like basically, it feels like it gives the feeling that there is it was a product that was bought. The people who sold it actually didn't know how to operate it. They're gone. And the company doesn't have anybody who really knows how to work with it and make it, add new features and keep it competitive. So I'll stop there. Let anybody have any questions or anything there. But
Yep.
yeah.
No, all very good, useful commentary, and obviously, with I guess a jaded tinge, which I think is valid. Jimmy, I want to hear your perspective. The bull among us, the man with the optimistic viewpoint. How are you feeling about what you're seeing from this brief release? Obviously, you got 20 minutes, so we'll hear more from management.
Yeah, thanks for having me, Rod, and it's good to be with you guys. Now, hey, I don't necessarily disagree with the comments that have been made, right? I think a lot of you guys are making observations, some very fair ones. For me, I think it's a matter of expectation. And for as bullish I can get on Twitter and Discord as kind of like an alter ego, like I have to, let's look at the macro environment. That's real. I've seen a couple of other apparel company releases, a couple of consumer quote unquote staples. Look at Target, Walmart. I mean, everyone's got inventory issues. Everyone's dealing with, a slowdown in consumer demand. I frankly think Playboy's done relatively perhaps better than most. $65 million of revenue in the second quarter. How much of that is centerfold? Almost zero, right? It's no doubt to me that they're playing defense. They've had to do triage. Clearly, there's little fires throughout the Playboy Mansion that are not being highlighted. But frankly, this is what it is with the stock at $300 million ish, right? Like we're aiming for 1.5 times EV to sales. Like this is where we find ourselves in. I don't think the tail duration opportunity changes. Now, that's not to say we can't be critical of what's gone right and what's gone wrong, but I think management was pretty forthright in their February, year-end conference call. Like, hey, 22 is a wash for Centerfold. For them, if I don't know if you heard what I heard, but that was their first way of saying, hey, let's temper our expectations. We're not including any contribution. We're including expenses, but we're not including G&A, but we're not including any contribution on the revenue side for 2022. We're looking just at our core retail apparel product, and they need to get that right. Now, obviously, there's been headwinds in retail, but DTC growth is still strong. I think Brian McGough just pointed out the core is flat to maybe slightly down. Almost all the incremental growth was driven by Honey Birdette, but Honey Birdette is still Playboy. It's still part of that flywheel, whether it's started or not. So, they'll probably take down guidance, but they're going to hit north of 300, if not 350. That's their original guidance. I think they can hit 300 plus. At today's prices, if you have the time and patience, again, I don't think anything's changed for me. This is, if we took out the stock price, which we can't because money's involved and we have our own P&L. Like if we were investing in this company as a private enterprise, I would say that, they've been taking small steps forward. Maybe we wanted them to take a bigger step forward, but all of us are swimming uphill. This is a tough environment for apparel. I think their gross margin, the fact that they preserved that was a positive. Let's see what they have to say on the call. And it is true that, 3 quarters ago in November, when everyone was hyped up on NFTs, I mean, that was the top, right? So maybe I'm more forgiving than some of you guys.
Sure, I think the point on gross margin is a good one. To try and look for the positives. I think it's a very valid point. In the quarter, gross margin was 57.2 ish. It looks like from my math. But I would ask, why is SG&A ramping like this? And we've heard, obviously, we're all aware of the fact that they went out and bought this plane that. And they bought in 2020. It was supposed to be a mansion in the sky, so to speak, for them to, and the Big Bunny brand, sub brand, their version of Jordan to Nike that they rolled out has been just an astounding failure from what I've seen, which was supposed to be paired with the plane, and I've seen just very little marketing on that front. So I know you had commented in the Discord that you view the plane still as an attractive marketing tool. All that, I guess, considered, is that a valid, I guess, stance of yours still? Do you still kind of feel strongly about that? Just curious, not trying to put you on the spot.
No, I mean, I think ultimately, we don't have a lot of insight onto how frequently it's being used. I know some of you guys are tracking their frequent trips to Jackson Hole. I think it's on brand. I think as the company scales, if they've acquired this plane, even accounting aside, I think it's something that they can utilize. I think it's something that continues to have like passive marketing value. But price drives narrative. We're in the pits right now. We don't have any real serious institutional capital in the name. This name and a bunch of small cap names are just blowing in the wind. So it's all fair game. I do want to hear more from management, though, right? I want more disclosure into G&A. I want to hear how they're thinking about SBC dilution, because a lot of small caps, right? A lot of D-SPACs that thought they were going to manage their dilution on the SBC front have seen their prices get cut by 2/3, and now all of a sudden they're diluting 3 to 5% a quarter, and that's real, right? If it kills that multi-bagger tail duration opportunity, then investors are much less likely to be patient to wait for the inflection point. That being said, they're going to get free cash flow positive in the second half. That's real. So compared to some other companies,
not the rate they're doing stock-based compensation.
I mean, again, depending on what you have for the second half in terms of revenues, between the first 2 quarters, we're at less than 150. We're going to probably see more than 150 in revenues in the second. I mean, how positive?
We're at 135. Yeah. So
yeah, I think we can get to 170 or 180, and that would be the ramp. Maybe it wasn't the 350 full year ramp, but I think that's, unless something terrible happens, that's still an expectation I have. So again, go ahead.
So just real quick, realized year to date 134.8, I think is what I have. I'm just looking at CIQ consensus, which is obviously going to come down after this, has them generating in the back half, if I can use my calculator here, 2077. So that's 134.8. So that's still 340.25. Obviously, that back half estimate needs to come down a lot. I think I'm with you that 300 is, I think, an achievable number, barring some really, really, really bad events going on into the fourth quarter. But yeah. So go ahead, guys.
Rod, I have to head out after this, but Jimmy, I just wanted to address, you can track what the plane is doing if you look up their tail number and you use websites that track ADSB information. The flights, the big money plane has just been taking pointless flights. Like, there have been a couple of days where it took 15-minute flights within Texas.
Has anyone tried to
DCC,
quantify the
you
expense?
Just shared that spreadsheet in the chat. If you could maybe tweet that, I can then add it to the pins up here if you're interested in. Sorry.
Yeah, no problem. I can do it.
Yeah, because the accounting is funny. There's a lot of corporate G&A in there, but you can also say there's some marketing expense in there that's above the line. So again, this hasn't been fully disclosed, but I think we'd all appreciate some insight into what the order of magnitude of that expense is. Now, I don't think it's that material, but some of you guys, I think, differ on that. I do care that, the retail is suffering because all retail is suffering, right? That solves a lot of problems.
Your point about apparel, I mean, look, we all saw Walmart come out, 2 weeks ago now, and they very specifically called out apparel. And look, if people are being hit with this meaningful food and fuel inflation that's eating away their discretionary spend, then something like apparel, especially for a higher cost anything brand, Walmart called that out, and I think that's a very good point, that apparel is going to be challenged. McGough has noted that 2.7 billion of the 3 billion in global spend against the brand is apparel. So roughly 90% of the spend is apparel based. Since we haven't seen the color cosmetics launch yet, it's going to be challenging in the short run. And I think the question marks then become things like, what does the cash burn or generation look like? You noted second half should be free cash positive. I don't know that full year will be free cash flow positive. They had, I think, guided to being slightly. And before facing these headwinds, I think that was doable. I'm not so sure that they'll be free cash flow positive for fiscal year 22. But again, to your point, this brand, if you assume that the brand is not actually impaired simply as a byproduct of demand faltering in a challenging macro environment, what can they get to? But I think then that's where all of these concerns about their ability to execute from the current team that is running the ship are serious concerns, and they're based on observable reality for those of us that have been very closely monitoring the name for the past 16 or 18 months. At the end of the day, I think in isolation, the asset strikes me as grossly mispriced. However, I'm not sure that management is the one to resolve that mispricing. And I guess we'll see. We're going to hear from them in about 10 minutes, some more detail. I'm going to keep this open. I'm going to, if folks are listening to it live, I'm going to see if I can get, I don't know if they do a live transcript for PLBY since there's such a small cap for Cap IQ. Let me see. I know some of the big caps have live transcription, but
and Rod, I'll say on the CEO part, I mean, it's a difficult environment to get talent regardless. If Ben goes, like, who else are you going to hire? I'm not being rhetorical or or snarky. We can come up with funny names, but it is a big responsibility to manage a franchise that still has a lot of tail duration appeal, that has global appeal. Finding a seasoned professional, how much you're going to have to pay them in equity comp.
I think one big, I guess, misalignment that I see, and I'd welcome folks to chime in with their thoughts. Anybody who's in the audience who hasn't chimed in, please, you're welcome. Even if you're not an investor or even if you're new to the name, we would just love to hear your perspective. But to the point about Ben Cohen, who had become interim CEO in 2016, who has been CEO now for 5 years, during which time the company was private for most of that. I guess the questions I have are, this guy, he's a private equity guy for his career. I've listened to a variety of interviews with him. And when I think about PLBY and the brand that it embodies, is a, I don't want to call him uptight, but is a, a middle-aged white guy who is not really charismatic, the right leader for the way they've tried to position the brand. Obviously, we haven't talked about it yet, but they've really leaned into the women's side of things, right? All of their photographers are female. 80+% of the staff, which a bulk of that jump was from buying Honey Birdette, but 80% plus of their employees are female. So if they could get a really bold, visionary female leader to kind of take the company into where it's pointing toward, like, to me, that would be the ideal outcome. Obviously, they had acquired Honey Birdette, and Elle Monahan, the founder of Honey Birdette, kind of fit some of the bill there. But it does appear, while she may still be working with the company in some capacity, obviously the I forget what medium it was that she posted in. She noted that there was some misalignment, I guess, between her working style and management's, i.e. Ben. So, look, at the end of the day, if there's, he has a huge stake in the company as a byproduct of the 21 compensation plan. And, as Dick Butt had to leave, but as he noted, Rizvi plus Ben, that's almost like 30% of the company. So it's kind of hard to do anything without, getting those folks in alignment. And I don't know. I obviously feel badly from a personal perspective. I had viewed this as a very favorable opportunity at much higher price levels, and regrettably, things don't always work out. And as somebody who tries to be transparent with their their investments and their thinking on things, I don't ever want to see people see their P&L impacted, but everybody has to own their own. Full disclosure, my personal accounts are fully covered by $5 covered calls that expire August 19th. So I had kind of expected, I guess, a weak result, and at least my pain is a little lessened, although I am down. It's the largest loss I've ever experienced in my investing career on an unrealized basis in dollars. So
I did want to, Rod, I wanted to jump in and add one more item here. that I had uncovered during my due diligence, there are a lot of flights to Jackson Hole. Nobody questions that. We see it on the ADSB tracker. The one thing is that I think that the outsourced group that was doing that's working on Centerfold is called Scale Tech Solutions. That was in one of the, I think it was on the 10K or one of the attachments there. Anyways, the Scale Tech Solutions is based out of Wyoming. So I think that these are more vacations, but there's like a cover that, we're visiting the outsourced office to work on Centerfold development in an era of Zoom
and I just
remote
pinned
work.
it to the top of this, folks, if you want to see that flight record.
Yeah, and I can reply to the tweet with the link to Open Corporates for where Scale Tech is located. So it's it's plausible. I don't think it's smart money management, but it's plausible that once a week somebody from corporate is flying over to meet in person with this outsource group, which is ridiculously expensive and a terrible capital allocation. But is it convenient that they chose somebody to outsource to that's located in Jackson Hole? You can make your own decision on that.
Yeah, I think eventually benefits of the doubt fall to the wayside. You only have so many benefits of the doubt as a management team in a company that came public in the form of a D-SPAC. And I think it's safe to say that they've exhausted those, at least in my view, personally. Again, I'm what I just mentioned with regard to my personal account. I'm obviously hosting this under the Wook Capital account. I'm speaking about my personal investment accounts as Rod Alsman, not as Wook Capital when I said that. But yeah, it's hard to give them benefits of the doubt and assume that competence will come into view when to that and to so many other things. We've just really not seen competent execution to date.
Yeah, I would, Rod, I would 100% agree with you there. Like, obviously, the macro environment's tough and stuff. And I just want to preface something you said a while ago, Jimmy. You were talking about how they are basically saying Centerfold is going to be a wash for this year and it's not going to be meaningful. But my question to them is, why spend $30 million on Dream, and why go hire Cardi B to advertise it? The live streams with her were brutal. The quality was from 2007. It just seems like they funneled a ton of money into this and then it didn't work. And now they're well, okay, this is a long-term strategy, but how much more money do they keep pushing into it before they just pull the plug? And you talk about the macro environment. I think if you take this management team and you take away the PLBY brand, this is a brutal quarter. I think the brand is really pulling the weight here. And again, that is the main thesis, but I've lost a lot of faith in the management, to be quite honest.
Yeah. I mean, we know what we know about the Dream acquisition, right? I don't have anything new to add. So whether they're going to spill the beans and say, hey, this was a mistake, this and that, again, from a management team's perspective, this is 1 or 2% of the company as it currently stands. It's a big part of the upside. I think we're right to be a little bit disappointed.
It's 10% as it currently stands.
Yeah, that's
it
was a heavy purchase. It seemed like they were ready to go.
Okay.
Full scale.
Again, I don't disagree with you there, but I think management has a strategy in place to not want to talk about that. So I understand why they would want to minimize something like that. And the future is yet to be written. Again, I think there's a lot more they could do with the Centerfold platform. I'm not happy with it either. But in terms of expectations, where the share price is and what I'm paying for today at $7 a share, I'm paying for PLBY to be an ongoing entity, right? For them to have enough cash flow to see this through. That's all I'm paying for, in my opinion, at today's price.
So to that point, just thinking about, I don't have it pulled up in front of me. I know that their debt covenants are based on an EBITDA multiple that does ramp down over quarters. I think it's maybe it's 4.5 for this quarter, and it gets tighter as time goes by. So a couple comments on what you just said about going concern. Adjusted EBITDA year to date is negative. It's negative 1.4 million. Obviously, we all can agree fourth quarter is going to be the primary contributor to that EBITDA. But I think there are serious questions about whether they are going to be, able to get to where they need to. And it kind of lends more credence to the fact that they did that preferred raise and seemingly didn't repurchase any shares with that capital. And my second point that I'm drawing a blank now, and I'll shut up, but I am, let me see if I can remember it, but I am seeing the price still declining in after hours, and the call is probably about to kick off. And unfortunately, CapIQ doesn't appear to have live transcription. And unfortunately, I don't see one that has annotation with the live player. So I'm going to keep this call open. If anybody is listening in another ear, I'm going to see if I can do that myself and try to multitask a little bit.
But, I got a question for you, Rod, and the rest of the group.
Yeah.
Knowing what we know now, is it better that they didn't buy back any shares? Like, they leave that open, right? They keep the cash on hand. They have the prefs, and they still have the dry powder if they need to buy back shares at a really, let's say S&P retests lows, right? And Playboy is in an all-time low. Maybe there's a better opportunity.
Hey, before anyone comments on that, I just wanted to ask anyone if they've seen any instances of any financing deals like that, just to look at it like comparatively, because like it was really confusing and to look at, and like again, if they haven't done any buybacks, like what was the real use there?
I've just seen the one, and it was really egregious. Luminar Technologies, hyped up LiDAR SPAC, they raised debt to buy back equity. And I still think they're fundamentally very much overvalued, and it didn't work. I think they did it when it was maybe trading in the low teens, and now it's in the single digits.
Yeah, that also was weird to me, the approach they went about doing that. And to respond to your comment, knowing what we know, now, was that a opportunistic way to keep themselves afloat? It does seem as such. Obviously, it was expensive, but that's where my concerns about the ongoing SBC, at high single digit run rate is really baffling. I mean, if we were to look at the trailing 12 months, it's egregious because of the fourth quarter. I get, we can all agree that's a one-timer, but seeing this on an ongoing basis at these levels, Mr. DCC left, but he made the point, did they structure this in dollars? And they're just, really paying out way higher because the equity, has declined so much. I don't know. Let me answer that. I do know the call's starting now, and I've got it playing in the background here, so I'm going to try to listen a little bit while we keep this open and see if we can kind of react live, see if we get any incremental information from the company. But yeah, looks like the operator's about to hand it over to Ben.
This call is also being webcast, and a replay will be posted to PLBY Group's investor relations website.
Again, if anybody wants to come up, chime in, investor or otherwise, please feel free. Any perspectives welcome. I'm going to be a little quieter as I try to maybe listen through one ear to the conversation from the company as well as this conversation.
And we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks which could cause PLBY Group's actual results to differ from historical results and forecasts, including those risks set forth in PLBY Group's filings with the SEC. You should refer to and carefully consider those for more information. This cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statements. During this call, PLBY will be referring to non-GAAP financial measures. These non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of the non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings release PLBY filed today in its Form 8-K with SEC. I will now open the call to Ben to please go ahead. Ben?
All right,
Thank you,
Ben,
Ashley.
starting
Good
his remarks.
afternoon, everyone. Today's climate is very different from when we first began to transform what had been a legacy media and licensing company into a fast-growing consumer and digital business. However, the robust demand for Playboy and Honey Birdette continues to hold strong, and I am optimistic about the recent trends we are seeing on Centerfold. That said, given the uncertainty in the macro environment, we have taken a close look at the factors within our control and have taken actions to best position the business to weather the headwinds and drive long-term growth. To that end, we restructured our debt and secured liquidity. We have amended our senior secured credit agreement to give us extra headroom to invest in the growth areas of the business and have drawn down the
credit
remaining
agreement.
$25 million in Series A preferred stock with Fortress. We now have approximately $70 million in cash equivalents, including crypto and restricted cash.
Yeah, no mention of buybacks there.
Yeah, they drew down the balance of the preferred, so he just talked about liquidity. It sounds like they've tapped that full $50 million now.
Continue to invest in growth areas, with the goal of being cash flow break even by the end of this year. The prioritization, along with our amended credit agreement, gives us the flexibility
Reiterated a
we
goal
need
of
to
cash flow
execute
break
on
even
our
by the end of the
strategy.
year.
I remain committed to our plan, which focuses on two key areas: growing and consolidating our consumer business with a focus on high-margin owned and operated products, and second, building out our creator-led platform, Centerfold. My confidence in the business and commitment to our long-term plan are evidenced by the approximately $850,000 of shares I bought in Q1, in addition to the $500,000 of shares I purchased when we went public. No named executive officer has sold any shares.
I can't believe you just
except to
called that
cover
out
the
in an
tax
earnings call.
obligation related
That's
to those
mind-boggling.
shares. However,
He has to go on.
the selling of shares for tax
Yeah,
purposes
I've never
has
seen
subject
that.
those executive officers to short swing profit rules. Hence, no named executive officer has bought any additional shares in Q2. At the corporate level, we have not repurchased shares given the rapidly deteriorating macroeconomic environment we witnessed just after we announced.
Confirmed there were no share repurchases and blamed short swing profit rule for no exec repurchases in the second quarter.
In our original forecast. However, we are also seeing some very encouraging bright spots in the business. Inflation is
They tapped
driving
the entire
higher
preferred to
fulfillment
raise
costs,
liquidity. They've not used
but
any
it is
toward
also putting
buybacks.
pressure on consumer spending. In keeping
8%
with
capital is not
recessionary
bad
buying
for them,
trends, we are seeing a greater
their stock
impact
trading
on our
right now.
value-oriented
Pretty sure it's
consumers
18%.
versus our luxury or higher-end consumers. Both Playboy and Honey Birdette caters to consumers drawn to luxury and aspirational brands, and we continue to see strong consumer demand for both brands, which are up considerably through the first 6 months of the year on a year-over-year basis. Playboy D2C revenue is up over 150%, and Honey Birdette is up approximately 28% on a pro forma basis. Playboy continues to see strong global consumer demand with the Gen
Honey Birdette up 28% on a pro forma basis. So that's probably the brightest point we can point to.
Featuring Romeo Beckham, Fila, and Studs. And we are expanding our portfolio to include Playboy lingerie, designed by the Honey Birdette team, which will launch later this year. Honey Birdette continues to deliver strong revenue growth and margins despite the macroeconomic headwinds. We conducted a soft launch with UPay to provide Honey Birdette customers with a third-party gifting option. From the early data, we are seeing strong conversion rates and direct acquisition of new customers. Given the success of the pilot, we are incorporating the option for all customers and will be adding wish list functionality. We are exploring using cases for our other brands as well as for Centerfold. On the retail front, our Miami store continues to be one of our top performers. We opened a new location in East London in late Q2, and more store openings are planned over the next few quarters. We will continue to expand Honey Birdette's retail footprint, diversify our product offerings, and grow brand awareness in the United States. Yandy lovers are seeing the opposite sales trends, as their cost-conscious customer is getting hit extremely hard at the gas pump and in the grocery store, leading to less spend on discretionary items. Compared to 2021, year-to-date revenue through the end of July declined $22 million between Yandy and Lovers combined, with over $18 million of the decline coming from Yandy. Supply chain disruptions continue to pressure margins throughout the business because seasonal inventory arrived off-cycle and had to be managed through disciplined promotions. Supply chain issues also impacted our ability to have the materials needed to launch new products and to keep product stocked during key seasonal windows. To manage through this, we have advanced stock key inventory, including our top sellers and seasonal items like Halloween costumes, and are introducing more owned and operated products throughout our business. Rising customer acquisition costs and last year's iOS privacy changes have significantly impacted performance marketing, particularly for Yandy. According to our external marketing partner, iOS IDFA updates led to a 50% year-over-year drop in Facebook conversion rates for fashion and apparel brands in Q2. As a result, brands have shifted budget away from Facebook and toward Google, which has driven up competition and prices for keyword spending, in what has historically been one of our key customer acquisition channels.
To give them a benefit of a doubt there, I work with a lot of marketers, and they're saying the same trends between the shift from Facebook to Google there on the ads.
Yeah, for folks who aren't listening to the call, we heard some color from Ben about Yandy and Lovers being down. I thought I heard 22 million, with 18 million from Yandy, and citing the customer acquisition cost spikes from the iOS privacy changes. I heard a 50% drop from Facebook conversions year over year. So the Honey Birdette business and brand appears strong and healthy. Yandy and Lovers dragging things down. He's still going.
Marketing. As I mentioned last quarter, there are three key elements required to make Centerfold successful: the brand, the product, and the creators. As for the brand, PLBY is one of the most recognized brands in the world, and we will be leveraging its massive reach as we integrate Centerfold within PLBY.com over time, ultimately driving all customers into one ecosystem. The Centerfold product, the platform itself, and the pace of progress to advance it have not met my expectations. When we decided to launch Centerfold, we had two options: build the platform from the ground up, a 12-month process in the best case scenario, assuming we had a full team in place, which we did not, or buy an existing platform to accelerate our market entry. We chose the latter, which provided speed to market and the ability to test and iterate on the product. The coding that goes into the back end to support messaging, payments, and creator records is extremely complicated. And unfortunately, our initial team, which was largely comprised of third-party offshore developers, was unable to make the needed progress on the platform. However, having a live product in market has provided us with much-needed test data to inform, prioritize, and accelerate our current product roadmap and creator strategy. Given the product issues we encountered, I quickly identified the need to upgrade our technology talent and recruited a new in-house tech team earlier this year, including product and engineering leaders from Uber, Google, Square, and Y Combinator. Since they have come on board, we've seen dramatic improvements in the stability of the platform and in new bulk features and back-end enhancements that will be rolled out later this year. From day one, the new team has been laser-focused on building a seamless creator platform with intuitive UI, leveraging data from our existing business and the ongoing feedback loop with creators and fans to inform our priorities and refine the platform. The relationship and expertise from our new team have also enabled us to work with premier technology and payment providers to ensure best-in-class functionality, accelerate development, and lower our overall cost basis. With Centerfold's improved technology, successful test cases, and a tailored creator strategy, we are executing on our Centerfold strategy in earnest. As the new technology improved, we work closely with our existing creators to monetize our audiences. A few weeks ago, we began onboarding new creators, and some of them are already approaching $10,000 in gross bookings in their first month, while also continuing to attract both new users and new creators onto the platform. We are encouraged by the momentum we are seeing across the creator base. For example, one of our creators who we recruited from within our PLBY ecosystem is now generating nearly $100,000 in gross bookings per month. She and her peers are also collectively bringing in millions of unique visitors, many of whom convert to registered users who then engage with and become paying fans of multiple creators on Centerfold. Our top referrer, for example, has driven over 100,000 registered users onto the platform through her personalized referral link across multiple third-party platforms, including Instagram and Reddit. What we need to do now is scale these wins. So we are leveraging what we've learned about these top performers to create repeatable processes, inform which types of creators to onboard, and arm them with the best practices to grow their subscriber base and optimize their performance on Centerfold. Before I became the CEO of PLBY Group, I was in private equity for a long time and have been through many economic cycles before. While the road ahead won't always be smooth, I am encouraged by our momentum and am confident in our people, our brand, and our long-term plan. I'll now turn the call over to Lance.
Thanks, Ben.
All right, Ben just finished his remarks. Lance is going to comment now, and we'll get to Q&A.
$5.4 million. Our growth was driven entirely by our direct-to-consumer segment, which was up 59% year over year to $44.6 million. As Ben alluded, within direct-to-consumer, we have seen a real bifurcation of performance, with Honey Birdette and Playboy achieving continued growth.
Again, for anybody who just joined or who's listening, we're kind of, I think most of us are listening to the call on the side, and we'll kind of return to commenting on the call after.
$2.4 million in the second quarter and up 37% on a constant currency basis. Growth at HB was driven by a 15% increase in brick and mortar revenue and a 49% increase in e-commerce. Solid growth on both fronts, despite Australia being more heavily impacted by the current macroeconomic situation and relatively low brand awareness for Honey Birdette in the U.S. Playboy e-com revenue in the second quarter grew 90% year over year, and revenue in the month of July eclipsed Yandy for the first time ever. While the Playboy brand continues to grow, our supply chain was hit especially hard in our licensed inventory, where we are heavily reliant on our partners around the world. We've made strides to increase our owned and operated portfolio. This includes bringing design and marketing in-house and hiring key people in these two areas from Victoria's Secret, Abercrombie, American Eagle, Calvin Klein, and Gap Body. The buying behavior of customers at Yandy and Lovers has been severely impacted by inflation, leading to a year-over-year decline in revenue of $8 million in the second quarter, the bulk of which was driven by Yandy. Yandy is also part of an unsustainable marketplace wholesale model with low margins and a highly saturated competitive set, which creates higher risk and exposure to supply chain challenges due to our supplier impacts. For example, Yandy was running a 50% out-of-stock rate during the first part of the second quarter. To mitigate this in the short term, we've made an effort to secure safety stock for our top 20 selling items as well as our Halloween merchandise. Similar to what we're trying to do at Playboy, our long-term focus at Yandy is to grow our owned and operated business, which should ultimately yield higher margins, more control, and enable a shift to profitable growth with less spend in paid media. Lovers saw significant raw material cost increases impacting product margins, and when combined with high fixed costs due to our store footprint, there is less flexibility for us to address the revenue shortfalls we have experienced due to declines in store traffic. Similar to what we experienced at Playboy and Yandy, we are highly dependent on a vendor model and their supply, which resulted in supply chain disruptions and out-of-stock items. That said, we've integrated our Lovers and Yandy buying teams, driving efficiencies and enabling us to reduce headcount. In our licensing segment, Q2 revenue was flat year over year to $15.9 million. Given the macro climate, some of our apparel and gaming partners have experienced weaker trends as the year has progressed, resulting in a reduction of reported revenue on our end. We believe these are more category-wide headwinds and not specific to our brand, as other partners have produced better than expected results, which help to offset the declines. Reported revenue from our partners in China was stable. However, the severity of COVID lockdowns in the country resulted in cash payments coming in after the quarter ended. We have signed amendments with our major partners that put them on payment plans to help them during this time. Instead of being paid by our partners semi-annually, we are shifting to more frequent payment plans for the next several quarters that will result in the majority of the expected cash payments arriving this year, with some amounts deferred to future periods. There is no revenue impact related to the new payment terms, as the overall contractual values remain intact. All partners have made their first payments. We've already received nearly half of the amounts that were past due, and we will continue to monitor the situation closely. In light of all of the macro challenges that have impacted our business and the uncertainty that lies ahead, we are withdrawing our prior financial outlook and suspending guidance for the remainder of this year.
They withdrew the outlook and suspended guidance.
Did not materialize as previously expected, and we must adapt our investment strategy accordingly. As Ben mentioned, we are currently undergoing a strategic review so that we can position the company to be cash flow break-even by the end of this year. While we remain focused on sustaining investments that we believe are most critical to executing on our long-term strategy of growing our direct-to-consumer and digital businesses, we are also focused on rationalizing our business to improve operating efficiency. We may incur transition costs that impact our financial results this year as we implement these changes, but we believe the work that we are doing now will allow us to enter 2023 as a more streamlined and efficient company, well-positioned to capture the global demand we continue to see for the Playboy and Honey Birdette brands.
Stock selling off hard on that news.
Although revenue is difficult for us to forecast in the current environment, we're very focused on cost levers that we can control. Embedded in our prior fiscal year 22 adjusted EBITDA outlook was an expectation that on a pro forma basis, non-product costs would increase by a little more than $30 million this year, an increase of roughly 17% year over year to over $210 million annually. Over half of that expected cost increase for this year, or more than $17 million, was expected to be driven by our investments in building out both our direct-to-consumer business and Centerfold. Around $7 million of the expected cost increase is due to technology and infrastructure costs as we work to consolidate operations, build a unified back-end across all of our direct-to-consumer businesses, and remedy our IT controls. The remaining $6 million or so is largely driven by corporate and public company costs, such as higher insurance and audit fees, along with additional resources in areas that the company has historically underinvested in, such as finance, accounting, tax, and compliance. Based on the cost reductions that we started making to the business last quarter when we took out approximately $5 million of annualized overhead, our current run rate on non-product costs is just under $200 million annually. As part of our ongoing strategic review, we are closely scrutinizing our investment plans for the remainder of the year, determining potential trade-offs and reducing costs where we can, such as eliminating planned hiring, reducing marketing spend, delaying planned product or store launches, and reducing headcount. We intend to be responsive to what we are seeing in the marketplace and to control our costs tightly so that we can manage our liquidity and balance sheet accordingly. One example of this is our near-term store expansion plans for Honey Birdette. Although the business continues to grow nicely, we are taking a more disciplined and cautious approach to store openings this year. We have already opened stores in Miami and Stratford, UK, and have signed leases for Short Hills, New Jersey, and International Plaza in Tampa. But we have decisions to make on the remaining store openings that were planned for this year. Our existing U.S. stores have performed quite well, averaging $1 million in annualized revenue per store with 30% four-wall EBITDA margins, which makes for a compelling argument to push forward with our previously communicated plans. However, we want to be mindful about taking on fixed long-term liabilities in the current environment until we better understand how long these conditions may persist and any potential impact on the Honey Birdette consumer. We also must consider the near-term cash impact, as each new store costs around $700,000 to build out, so we'll have a roughly 2-year payback period on any initial cash outlay. While we believe we have ample liquidity to open more Honey Birdette stores this year, we want to ensure we have enough cushion to withstand any potential disruptions to our expected cash receipts. Although the business has been presented with many obstacles this year, Ben, Ashley, myself, and the rest of the management team firmly believe in the long-term potential for value creation that exists. We'll make near-term cost adjustments that are needed.
So we've got the Short Hills and Tampa Honey Birdette store signings, but outside that, it sounds like they're pausing store expansion in the immediate term to save cash and also observe what happens in the consumer environment for Honey Birdette.
To ask a question, you will need to press star 11 on your
Here comes
telephone.
Q&A.
Please stand by while we compile the Q&A roster.
I want to hear some questions about the lack of increase in the licensing revenue from China.
And our first question will come from Alex Furman of Craig-Hallum. Your line is open.
In interpreting your comments here that, you know, the bulk of the slowdown here and the need to suspend guidance is related to Yandy and Lovers. It sounds like Honey Birdette and the Playboy brand, at least in terms of your direct-to-consumer sales on the Playboy brand, remain strong. I don't know if that's, maybe they've slowed down as well, but just still continue to grow nicely, or have those brands, not seen the same sequential deterioration that you've seen at Yandy and Lovers.
Thanks, Alex. Yeah, look, I think that's right. I think when you look out for the rest of the year,
did I lose you guys?
Coming into this year. Sorry? Sorry, I thought you said something. Looking out to the rest of the year, Halloween is a big period of revenue for Yandy. And if you were to assume Yandy were flat to last year, and if you realize that we had left around $3 million of revenue on the table last year at Yandy when we had to shut down the warehouse over Halloween, which we think we've remedied those problems. If you take that as kind of the high watermark for revenue in the fourth quarter, and then you actually look at the current trends that we've seen in the business year to date, you're looking at kind of a $15 to $18 million potential swing between current trends and kind of what we would achieve if we were flat to last year, plus kind of that $3 million. So that's obviously a lot of uncertainty for one business and one quarter alone. I think the other things that we have to factor in is, what do we decide to do around Honey Birdette store openings? It doesn't have a huge impact on revenue for the remainder of the year because these store openings would be planned to be opening later on. But it could certainly have an impact for us. Same thing on the marketing side. If we choose to pull back marketing in light of kind of the decreased efficiency, the higher cost of customer acquisition, that in turn would have an impact on revenue. Same thing on the licensing side. It's predictable, but as we saw in the second quarter, if our partners start to experience worsening trends and then they come to us and say, hey, our forecast for the rest of the year is lower than we said it was in Q2, we're going to have to take down revenue even further. So I think there's just a lot of uncertainty out there that we don't feel comfortable trying to put out a number that in a way could vary quite widely.
Yeah, no, that makes a lot of sense, Lance. Thank you. And then that, the decision to pull back on the Honey Birdette store openings, is that just, part of that uncertainty you mentioned and fear that, maybe that brand could start to, see the consumer under pressure? Or is that just, as you look at your expenses, is that just, the most obvious, easiest place to pull back on spending this year?
Look, the
10Q is
out.
out.
Tough decision to make, right? Because these stores are performing so well here in the U.S., right? I mentioned that the average store here in the U.S., pulls in $1 million annually, and they're 30% four-wall EBITDA margins. So when you look at that, it's obviously in our best interest to go ahead and open more stores. But having said that, in the current environment where we've not seen any impact on the higher end luxury consumer that frequents Honey Birdette, it's hard to know what's going to happen. And we think it's prudent when you're entering into these long-term fixed liabilities to take a pause, see how things unfold. And quite frankly, we may be able to get better deals on some of these leases down the road. So, we're going to evaluate each one kind of individually and decide what we want to do. We've got the flexibility, I think, to open more, but we do want to take a more prudent approach. So there's nothing that we've seen that indicates a slowdown at Honey Birdette, but at the same time, a lot of things are changing quite rapidly in the environment, and we just want to be mindful of that. And we want to, watch for the impact of it.
I appended the tweet that I had the earnings news release to have the 10Q link, FYI.
it could end up hitting the luxury market next.
Sure, that makes sense. Thank you, Lance.
And our next question will come from George Kelly of Roth.
So just to start with the licensing business, seemed to hold in there fairly well in the quarter. I mean, I think it grew kind of low single-digit percentage. Just curious, has that changed subsequent to the quarter, or is that business continuing to perform and grow year over year?
So I'll talk a little bit about the financials, and maybe Ashley and Ben can just talk about some of the trends that we're seeing more broadly with kind of business development and our partnerships there. But yeah, it was flat year over year. There were a few drivers behind it. In China, in particular, there was no impact on revenue, as I mentioned. All of those contracts remain kind of the same amounts over the duration of the term, so we're able to book the same amount of revenue. What we saw was some of our apparel partners and some of our gaming partners outside of China, so more domestically and also in Europe, came out in the second quarter and basically had brought down their guidance for the full year. So in turn, we have to reduce the amount of overages that we end up booking. So you had that kind of dragging down the revenue that you recognize for licensing in the second quarter. On the flip side, we had a number of partners that actually surprised us to the upside, that actually had performed better than we expected and delivered overages. So it's a little bit of a mix. Obviously, I think it's, from our perspective, it's really the macro environment. It's hit some of our partners harder than others. But in general, I would say over the longer term, our view has been that this should be kind of a single-digit grower. If you didn't have that reduction that our partners had in the second quarter, again, they brought down full-year numbers, so that had kind of an outsized impact on the second quarter. But if you didn't have that reduction in forecast, you still would have grown this business probably 5-6%, something like that. So that's kind of what we're seeing there. Ben, Ashley, anything to add just kind of on the collaborations that we're doing?
Yeah, George, it's Ben. Look, I think the Playboy brand, both with partners and with consumers, remains extremely strong. This is really more of a macroeconomic environment outside of it that's affecting almost every other retailer today. And so I'm not worried about the Playboy brand. The engagement amongst our fans is huge. It continues to grow. The interest from partners continues to grow. But again, what we can't predict internally is, what the people in Washington do. They must have taken different economic classes than I took by putting more fuel to the fire, regardless of what their models tell them. And what the impact is on inflation and consumer spend long term is real. And so that's the challenge in front of us, like any other consumer product company for the balance of the year. It's not the demand from both consumers and partners.
Okay, that's helpful. So just to put that, what I'm hearing is, there's impacts that you're doing, but there hasn't been some kind of recent dramatic fall off in your licensing business.
No, that's absolutely correct. We've been very stable in the licensing business. It was, like I said, some puts and takes. You had some people pulling back their forecast. So
in the queue, under 19, they entered into an amendment to the credit agreement yesterday. So it looks like the leverage ratios got reduced. But we can touch on all that when they're done.
But like I said, there were other licensees that came in and offset some of those losses. So net, we were flat year on year. Like I said, our view is longer term, this should be kind of a single-digit grower. The other thing is we've already signed.
And they tapped the balance of the preferreds yesterday as well.
Last year. So certainly the interest level and kind of the volume of new deals remains quite strong.
Okay, great. And then just one other question from me. Lance, I was hoping you could go back through the cost discussion that you had in your prepared remarks. And I guess what I'm trying to understand is, I look at SG&A. I think you were also talking about some of what's in COGS. But I guess the direct question is just, should SG&A, I mean, is there room for SG&A to decline from where it was in 2Q, or what are your expectations around SG&A for the remainder of the year?
Yeah, the way I was trying to frame it was non-product costs, right? So product costs, I mean, if you look at kind of our model, our prior guide, the $350 million of revenue and $55 million of EBITDA, you'd get to about a 25% cost of product. That's obviously that 25% is going to be whatever your revenue is. So that number kind of varies. But the non-product costs, I mean, it obviously has variable costs in there, such as marketing and the like, and shipping costs. But it has a lot of fixed costs in there. It has a store cost, it has employee headcount costs, tech infrastructure costs. And so what I was saying is, going into the year, the assumption on that, call it non-product cost, was going to be north of $210 million. So it was going to be about 17% year-on-year growth, if you had included kind of the full year impact of Honey Birdette and Lovers last year. And what I said is, we've already made some cuts to the business. Our run rate is below that. It's actually around $200 million. And the work that we're doing right now is figuring out how much further we want to take that down. So yes, to your point, we believe there are more costs that we can reduce out of that $200 million. Again, we want to be able to sustain longer-term growth investments here. We want to be really mindful of kind of the long-term potential for value creation. But at the same time, we've got to make sure that we're operating as efficiently as possible. And a lot of the work that we've been doing this year has been related to putting in place the controls, putting in place the infrastructure and processes to allow us to be more efficient and to emerge this year as a more efficient company. So what I am, most interested in when I think about rolling ahead into 2023 and beyond, you're kind of putting in place that cost infrastructure this year. It really shouldn't significantly grow beyond whatever headcount you really need to support the continued growth of direct-to-consumer or Centerfold in future years. Your tech and infrastructure costs that you're putting in this year, call it $7 million, whether the business does $300 million or $600 million of revenue, that tech cost is going to be largely $7 million. Maybe it goes up by $1 million if you were to double your revenue, but it's largely a set cost. So yeah, I think there is a lot of room for operating leverage in this model. What we've got to do is figure out how to pull back where we can and be more efficient where we can, and continue to support growth in the areas that we think make sense.
Understood. Thanks. I'll head back in the queue.
Yeah, George, I'll just add, I spent 20 plus years in private equity. We've done this before. I've done this before. And, the biggest thing for us is making sure that we preserve the high growth areas that we see in the future, but we will not leave any stone unturned. We will take every cost out of the company that we can take out in order to preserve maximum in the future, but we will not leave any stone unturned. We will take every cost out of the company that we can take out in order to preserve maximum liquidity for the company. And that's the process that we're doing. We know there's more to be done, and we will do that because that's in the best interest of everyone.
And our next question will come from Jason Tilchen of Canaccord Genuity. Your line's open.
Yeah, thanks for taking the question. Just going back to the rebrand of Yandy, I'm curious, is that planned for ahead of the Halloween season, or is that going to be sort of later in the year? And then just sort of at a higher level, the decision to do a full rebrand there versus sort of just launching a Playboy brand at Lovers. Curious what went into that decision. And then just a follow up to that is on the Honey Birdette designed line, is that going to be planned for just Yandy, for just the Playboy.com brand, for both? And how do you view positioning that brand with the different price points of your D2C offering? Thanks.
Hi, this is Ashley. I'll jump in on the Yandy rebrand and the other areas. So just speaking to the rebrand first, the Yandy rebrand will start to hit the consumer in fall, so right leading up to the Halloween season. You'll start to see the new imagery come through with the new product that we have coming through. One thing that is important to understand is we're doing this more as a rolling change because we still have old product and imagery we need to work our way through. And so it's not going to be a lights up, but more of a rollout through the Halloween season, but in advance of peak Halloween, all the way through the back half of the year. And then we will continue to right size the inventory where we have kind of older product or older imagery. And then with that, we'll be leveraging the PLBY brand and haloing that into the Yandy business. So we'll have a more curated and cross-pollinated selling experience where you'll be able to buy Halloween as an example on both Yandy and PLBY, leveraging the bunny suit and some of the unique areas that Yandy brings to the table for the Halloween costumes. From a other brand standpoint, so lovers, we are starting with the PLBY Pleasure as our intro into a PLBY sexual wellness line. That will launch at the end of this year, and we'll be leveraging the Lovers stores, not only for PLBY apparel, but also for product in that sexual wellness space. And we will continue to elevate the brand across the board, so meaning we will have PLBY Pleasure look and feel like the PLBY brand, and we will start to elevate our Lovers store experience and our Lovers online experience in line with that, so we can ensure that we're gaining the most out of that line. And then for Honey Birdette, on the Honey Birdette side, we're going to continue to diversify the product offer and continue to go after that elevated luxury customer, keeping that more uniquely HB focused. We leveraged the design team and the resources from the Honey Birdette team to help bring PLBY lingerie to market. That line is in the mid-price point, so we're not going after the luxury customer. We're going after that mid-tier price point that will really speak to a little bit more of from a competitive standpoint, maybe that Victoria's Secret pink or Aerie or the lingerie that sits to that Gen Z consumer, where we're seeing such high synergy with the Gen Z customer coming to PLBY today.
Great. Thanks, Ashley. And then just on the cost savings that were identified in Q2, the $5 million I think that Lance mentioned, is that more from the synergies as the integration work on these different DTC businesses takes place, or was there some other area that was identified as sort of low-hanging fruit to cut those costs?
Yeah, it's the former. We had talked about it a little bit, I think, that happened right before our last call, but it was largely headcount related at that point in time. A lot of what we're doing right now is, as we put in place these processes and systems, we're able to be more efficient about how we staff these things. So that was largely what we had done, I think it was back in May.
Great. Thank you.
And our next question will come from Jim Duffy of Stifel.
Still working through the Q&A. Hopefully they'll wrap this in 10, 15 minutes and we can start talking about what we heard.
Again, your line is open.
I'm assuming you said Jim Duffy?
Yes, that's correct.
Okay, I'm sorry I didn't hear that. Good afternoon, everyone. Thanks for taking my questions. First, I wanted to ask some clarification around your comment on Centerfold. Ben, you were clear Centerfold not meeting your expectations for progress. But you also gave some metrics which suggested some decent traction. You had previously been speaking to an expectation for notable revenue contribution from Centerfold in the second half of the year. Is that still the expectation?
Hey, Jim. Thanks for the question. Centerfold did not meet my expectations. We definitely had an issue on the personnel side, and as CEO, I pivoted quickly and recruited a new team. What I would say is we were very lucky to get a team that came.
Ben just pretty explicitly acknowledged that the Dream purchase was a failure and that they had personnel issues with that acqui-hire.
Product company historically is not the easiest thing, and obviously it took us longer to do that than that we were expecting. What I'm encouraged about on Centerfold, and we have a lot of improvements coming this fall, is the revenue that we are seeing with our top creators, and then also the new creators that we started to onboard recently. So we had stopped onboarding creators because of the tech challenges that we had, and until those were situated, I didn't want to burn through that. But what we are seeing is that creators can monetize themselves on the platform. And so now it's a question of, as we've gathered this data, it's signing more of those creators. We have a robust wait list, and it's onboarding those creators for scale. The good news is that the product is now working. We have fixed the back-end issues on it. There'll be a lot more enhancements coming over the next few months that will make it even better. And then it's a question about just scaling the creator side of it. But our top creators are making almost $100,000 a month now. The new creators that we've been onboarding are at about $10,000. And what we're seeing from a cohort analysis.
You just said the top creators on the platform are making more than $100K a month.
So now it's just a question of scale.
Understood. Thank you for that. Then let's add a few questions.
Wonder how much those top creators are making in stock-based comp.
Comment on the receivables, which look elevated, and also give us some color on the composition of your inventory balances.
Yeah, on the receivables, as I mentioned, we had some payables or some receivables that had been due to us by the end of June. Those ended up coming in since June 30th, so that's a big driver of that. On the inventory balances, sorry, what was the question specifically on
just
that?
Like the quality and composition of your inventory. Do you have any issues where you're concerned about having to discount the merchandise to clear it? Is there an in-transit component of that that's elevating the balances? Anything to help us just get our arms around, the quality of that inventory which we're seeing on the books, because it looks elevated relative to where it's been.
Hi, this is Ashley. I'm jumping in again. I'll speak to the inventory. So overall, I feel confident with where our inventory is positioned. A couple of strategies that we intentionally went after, which did inflate our inventory earlier than usual, were related to Halloween and top 20 performing styles, was to early receipts. Heading into the Halloween season for Playboy and Yandy in particular poses risk with the supply chain as disruptive as it's been. And so we made a decision to early receipt inventory in order to have it there for peak selling season. So that's a component of why our inventory coming out of the quarter was more inflated than usual, but it will serve us well in the late Q3 period and heading into October. The second area is we have seen significant growth and are continuing to see significant growth out of Honey Birdette. And so that business is an area we're fueling with inventory to drive that, and have also prepared for new store openings. And so as you start to come out of the year, you'll see the inventory align, but it's intentional so we can set these new stores up properly. Of course, there's areas where we are managing our inventory and leveraging disciplined promotional management and pricing actions to right size, but we feel confident that we've got the right strategies in place to address where we're slightly heavy, and that bringing in inventory early was the right decision to set us up for Q3 success and Q4.
Thanks for that, Ashley. And then my last question, it sounds like you're exploring a number of different avenues to shore up liquidity. Have you considered monetizing some of the assets that aren't necessarily delivering a return for shareholders, such as the art portfolio or even the Big Bunny jet, to improve the liquidity situation?
Question about monetizing the art portfolio and jet.
We've amended our credit facility to create headroom. We have about $70 million of cash and cash equivalents on the balance sheet as of today. What I would say is there are no sacred cows. We will do whatever we need to do to create the maximum liquidity for the business and invest in areas of growth to continue to maintain our long-term plan. And so if that's selling the art or selling the plane or anything in between, we will do anything in the best interest of our shareholders.
Thank you.
Then deflected and said there are no sacred cows. We'll do everything in the best interest of our shareholders. And that was it. Call's wrapped. Okay. Fun. Let me got both my earpods in now, buddy. You're the only one up here. Anyone who wants to come on up and chime in, please feel free to It's 5:50 Eastern time. I intend to run this. If we have a conversation going, I'm happy to run it for another hour if the conversation's there. Otherwise, we'll wrap when we run out of things to talk about. But I'm gonna, I guess, try to cover. I'm just trying to take notes and keep this going. So let me talk about the main things. So first and foremost, they've withdrawn guidance. So there's now no guidance on the year. As I noted, just to reiterate, the Q is out. I do have the Q in the, if you look at the tweet that I have pinned with the link to the news release, the Q is below that. They adjusted their, they modified the terms of their credit agreement for their term loan. They also tapped the remaining 25 million of the preferreds, and they reiterated a few times they have about 70 million in cash and cash equivalents. Right at the end there, obviously they got the question about monetizing the art portfolio and the jet. So they're basically now in a very defensive posture. They talked about the Short Hills, New Jersey, and the Tampa International Honey Birdette store. The leases are signed on those. However, they are pausing incremental lease signings on the Honey Birdette side, in spite of that being the primary growth vector that they've been experiencing. So that's questionable. I think it'd be good to talk about. They discussed on the, they had the most forthright comeuppance, I guess you could say, with regard to the Dream Acquihire yet. The question about Centerfold, the response from Ben was that it did not meet my expectations and that we had issues on the personnel side, but he reiterated multiple times that there are a lot of improvements coming this fall. They talked about top creators making 100,000 per month. I don't know if that's creators plural, because the data I've seen don't seem to align with that. However, I'm limited in what I've seen. And it's entirely possible that they've really hit the accelerator in the last few weeks here. But they basically are pressing pause on growth. They're seeing huge issues with cost on the customer acquisition side for their lower tier company, their Yandy brand. They're rebranding Yandy. It sounds like this rebrand will occur in the fall, leading up to and through Halloween. It'll be a rolling change. They're basically going to, it sounded like they're going to call it Playboy Pleasure, if I heard correctly. I don't know exactly what that means, but it does, they saw significant year-over-year declines in revenue from Yandy as a result of the iOS changes, is what they had noted. And they've obviously had the ongoing supply chain issues with Yandy largely being, third-party supplied from China. So that they talked about, launching Playboy Honey Birdette designed Playboy branded lingerie at a price point akin to Victoria's Secret Pink and Aerie, targeting that Gen Z customer. And that's launching, end of year. They're going to have that in Lovers stores as well. Licensing, they noted that they had no impact on revenue in China, given the contracted minimums. However, there's a timing issue with regard to actually receiving the cash. And they talked about changing it going forward, so it will no longer be a semi-annual remittance, but it, I guess, will be quarterly or something like that. And they've eliminated planned hiring, planned store and product launches, reducing headcount. Obviously, I mentioned but for those 2 new stores on Honey Birdette are pausing, even though they have a 2-year payback period. So, they noted they're not seeing a decline in the luxury customer yet, but it sounds like they are apprehensive and taking a wait and see approach to see, how they react as the year goes by. A lot of information, most of it not so good. Again, buddy, I know you're up here. I don't want to force you to talk, but a lot of see you're in the audience. Anybody else is more than welcome to come on up and, touch on whichever points, you'd like to touch on. And if there's nothing to talk about, yeah, we can wrap. But hopefully that's a decent synopsis of the call. It's definitely significant deterioration from what they had to say just a few months back.
Yeah, no, I would definitely agree with that, and I'm quite happy that I hedged myself walking into this one. Obviously the outlook hasn't been good, but they kind of just reaffirmed that. In the call there, I was starting to get the feel sometimes that they were like obviously Ben admitting the issues with Centerfold, and the team there, but then there's like he's still making those comments where he's really trying to like pump himself up, his team, and like I don't know, when you're looking at a company with the enterprise value like this, and they're talking about hiring like 3 to 4 developers from just other tech companies, and they're name dropping those companies in earnings calls. It's a bit of a flag for me personally. And like the $100 revenue thing, that must be like Cardi B, and like she's already getting paid by the company like through their streams, or maybe a handful of others. But I thought they were quite misleading on those stats. Like I bet.
Yeah, it very misleading. Like, are those dollar figures net from customers? It sounds to me like it's net of share-based comp, but I don't know. They didn't really go into that.
Yeah, because if we're looking at like subscription revenue here, like if those numbers are true, like we're like it would start to become meaningful. And like again, like the analyst I kind of said too, like you just said you're disappointed, and then you started bringing up all these great stats. So like kind of where are you sitting with it? And that's just yet another flag from the management for me.
Yep. So, they did reiterate, just to go down the creator rabbit hole a little bit further. I was trying to take down notes that, Ben said, we are seeing that creators can monetize themselves on the platform. We have a robust wait list. The product is working. We've fixed back-end issues. He noted the intent, and I don't think they hit on an exact time horizon, where centerfold.com is fully integrated with playboy.com. Obviously, that makes a lot of sense. However, I don't, and I had to step aside for a second, and I might have missed him discussing further detail on that. But I think that it gets back to, Ben made a comment I think it was the prepared remarks about Centerfold. He said brand, product, and creators will make Centerfold successful. Clearly, they have number one, and it does look like they have number three. But it gets back to what you just said. Like, they're calling out a handful of folks from a few, let's call them tier A, whatever, tech companies. But the product is just not there. The product is really disappointing. He's alluded to really since day one that there's a lot of improvements coming in months, and that message continues to be a lot of improvements are coming in months. And obviously we now have more color that there were personnel issues earlier in the year. Now, why that wasn't relayed in May, I'm not sure. Right? It sounds like it happened before May, but maybe I missed something, and maybe I'm incomplete on my assessment there. But there was some, I guess, admittance of things that have gone wrong. But I then get back to, why is this where you are now seemingly prioritizing your spend, whereas you have evidence that Honey Birdette is continuing to grow, and that the demand is there, and that both the four-wall profitability for stores, as well as, of course, e-commerce profitability is there. That's owned and operated, right? Why are you now pausing investment seemingly into that, brand, continuing to grow it, right? There's literally going to now be one store in the northeastern United States, 2 stores in Florida, and every other store is in Nevada or California. There's a huge swathe of the U.S., Texas, I think of the Chicagoland area, right? That I don't understand why you wouldn't continue to open stores in the top A tier malls where look, that may be, they talked about the 2-year payback. Lance talked about $700K to open a store. He alluded to in the Q&A, a view that maybe lease pricing comes down as the economy continues to cool. But I still just can't understand how you made this massive investment in a company that is now, you spent more than the current implied market cap based on after hours trading on Honey Birdette, and yet now you're pressing pause on that growth. And it doesn't make sense to me. But maybe I'm missing something.
Yeah, no, I 100% agree. I feel like we're all just like broken records back to each other, because it's this whole situation, to be honest, just seems a little ridiculous to me. I wasn't expecting it with the management team when I first looked into it. But yeah, I agree. It's a little confusing to me, because they talk about the low cost, right? Like it's not incredibly expensive. I don't know about down in the States, to be honest, but like commercial real estate never really even got expensive, like in terms of malls and stuff up here in Canada, in the last 3 or 4 years. Like, I don't know how much you'd expect it to really cool there. And I've also looked into some data too, and it's more known that high end luxury goods that aren't like massive kind of brands. They often do like better through recessions, like relative, just because those customers are less price elastic. So like a lot of what they're saying just doesn't really add up to me anymore, and I might have to take my first stab at shorting a stock, to be honest.
Oof, brutal. It's tough to hear. Hey, hey, Lod.
What's up,
How are
guys?
you?
Hi, Rod. What's up?
Hey, man. What time is it in Israel?
It's 1 right now. Yeah, I
Oh
have to
boy,
be quiet
stayed
so I
up. You
don't.
stayed up for this.
Yeah, of course. I'll probably have to smoke something after it as well. So about the HB store opening, I just wanted to say what I think about it. So it's pretty clear it's an excuse. They didn't open new stores when they said they would before the new macro environment. They said they would open, I think, 10 stores in 2021. Now they're not doing it in 2022. I think I told you that I think there is a net -4 stores since they acquired Honey Birdette. They closed a few stores in Australia. So I think it's pretty clear right now that Ben has to go. And the one positive thing that I did see in the call is that that's the first time that I can tell that he's taking accountability for what he has done. I think that's the first time he actually says they have made mistakes, and that's something that I like to see. But obviously, I'm not convinced yet that they will actually change things. What I would like to see is the last analyst said that are you going to sell the jet, the art? If Ben Cohen is going to sell the big bunny, that might convince me that there is a chance and they will actually change things. But if he's not going to do it, I guess we just have to pray that we'll have enough power to change management, or I don't know, he decides to retire for some reason. Another one point I have to make about Yandy, the huge acceleration that we have seen there didn't surprise me at all. In Yandy, last year they messed up with almost every Halloween order. So obviously, I think it's pretty clear that they're losing customers right now. It's not only the macro environment. And that's pretty much it. I mean, the good parts are Playboy and Honey Birdette, obviously. I'm just thinking the day that Ben Cohen resigns, leaves the company, this thing could double the same day, and I won't be surprised just because the licensing business by itself is worth more than the current enterprise valuation in my book, at least. That's for me, and it's a pretty bad quarter, but I know most of us knew what is about to come.
Yeah, thanks for the comments a lot. To comment on the price for a second. Yeah, it was kind of, you saw the meme basket, if you will, right? That had rallied very strongly the last 2 weeks, I guess, really this past week in particular. Playboy obviously is relatively heavily shorted and seems to have gotten some of that covering rally momentum. It closed yesterday at, what was it? Above 750, give or take. So it's basically now in after hours back around $6, which is close to the low point, and obviously remains to be seen how it will trade tomorrow. But this was pitched right as a growth brand, and yet to your point, Yandy obviously declining growth. declining revenue, excuse me. You're pressing pause on growth growth on the Honey Birdette brand that you acquired in the third quarter of 2021. It almost is like, I don't know. I don't know if there's any evidence to back the idea that there's a prospective route for RISV Travers to retake this private. Lance mentioned the $6 million in public company costs. They had spoken to the view that having the mark public was beneficial, and obviously it's hard to use equity to attract people at this really depressed valuation.
I don't think they're going to take it private, and I will tell you why. They're sitting on this asset for 10 years and they didn't really do much with it. We can obviously see that they're horrible operators. So what we will do with it if they take it private? Maybe someone else.
Yeah, maybe maybe Ryan Cohen's looking for another failing retailer.
Yeah, I don't know if this brand speaks to him, but somebody could put it on his radar that for 20 odd million bucks, he could buy 10% of it if he wanted to and send things going haywire again. I have no idea. I'm literally just conjecture on that front. But yeah, there's really not much that's positive. I mean, the licensing business being flat, again, it's sticky, right? Like the contracted minimums in China, they talked about not having a revenue impact. As bad as those deals may be, they have real economic value, right? If you're generating 1.5 billion in sales off of a brand and realizing, let's call it 50-ish million in annual revenue. And the issue with this company, though, since day one has been the cost structure. And Lance talked about a view that the fixed costs have largely been fully built out, which is great if the top line continues to accelerate and they get that operating leverage. But the fixed cost level just seems extraordinarily high for a company this size. And it's almost like they expected to be growing so much more quickly that they built and bought and hired in anticipation of all that. And obviously the macro, sure, it did decelerate, I think, versus most folks' expectations for 2022, right? If you look at, go back 8 months, economist estimates for full year growth in the United States have been marked down massively. Obviously, we've had 2 consecutive quarters of declining GDP. We could argue about whether that's a recession or not, but regardless, it just, I don't have confidence personally in what management is kind of bringing to bear. Like the disconnect to me is, how do you press pause on a brand that is continuing to grow, that you have severe underpenetration? They've talked multiple times previously about the billboard effect that the stores serve, and yet you have mass swathes of the country that you don't have any of those billboards. And they talked about the Miami store again performing at a very high level. Great. I suspect the Tampa store and the Short Hills, New Jersey stores also will. They talk about the 2-year payback, and it's like, if you're that worried about a 2-year payback on a project for your, like, what are we missing? There's something wrong. That I don't know.
Obviously, there is something wrong when you could get the entire company right now private. You could fire everyone. You could have 60 million with NOLs you're getting every year. And
right,
now they
200
acquired
million in NOLs, which probably went up.
Yeah, above 200 million. And they also have Honey Birdette, which should do what? 20, 30 million of free cash flow a year, and they're still losing money. How is that? What are they doing? One thing I did want to add about Centerfold, I know you think they should close it entirely, and I think the only reason I agree with you about that is Ben Cohen is the operator. I mean, the second that you bring in a decent one, I might change my mind about Centerfold, because I actually think, given everything we know, that Centerfold is dog shit. I mean, the platform itself. The people behind it are really bad operators. They have less than 2,000 creators. And I still think they did get a modest success given everything we know. I mean, obviously they failed miserably, but given what we know, I think the Playboy brand showed us that there is something there, and maybe someone else could make it work. Obviously, they're not going to close it, and they're investing in it instead of Honey Birdette, which is obviously, in my view, a very bad decision. But maybe Centerfold will surprise us, probably under a better management than Coin.
Yeah. So
what do you think?
This is I really don't know. I really don't see, going back to the comment I made about, okay, you have the brand, great. You have creators, great. I understood, what I guess their thinking was, but then I go back to, you and I have had this discussion. I know a lot, but just for the sake of the audience, when this company came public via de-SPAC, that was not part of anything put forward to the public in terms of the investing public. There was no pitch for a creator platform, and we can step back and understand that there was the OnlyFans snafu that happened in 21 that they viewed as an opportunistic in for them to try and offer an alternative, and clearly they got over their heels. They're not, and they haven't proven themselves competent operators for the other products, the Yandy and Honey Birdette. Really, Honey Birdette I think is performing well, even given that they have this management team kind of at the reins. And presumably they would be doing even better if it weren't for this management team. One thing I'm looking at now, I'm looking at the Q and I'm looking at the filing from the company. So they reported on the Q that as of August 1st, there were 45.63 million shares outstanding. Yet the weighted average, it's because of diluted and non-diluted. Never mind. Sorry. Didn't mean to take us off the rails there. But yeah, regardless, the continued dilution, there were no questions about the SBC from the analysts, which is disappointing given the extraordinarily high level that it remains at.
Didn't they say it will be around 2 to 4% after the full revenue?
That's what I heard relayed from, I didn't have this conversation directly. This was relayed from Hedge Eye's retail analyst.
So what will be the full year run rate of the stock-based compensation? Around 9%,
well, if we
10%?
just look at year to date, yeah, exactly. It's high single digit. If we included 4Q21, it would be off the charts. So the trailing 12 months is insane. But yeah, it's out of line with what was voiced as a steady state. It's way out of line. 2 to 4 is a lot different than 8 9.
Ben has to be compensated for taking the jet to his ski trips. I mean, of course.
Yeah. So, looking at the Q, obviously they, as I mentioned, took the cash after the quarter end. So, and they have 44.6 on the June 30th Q, but then you got to add the 25 million to that or the 24.5 million from the preferred. They noted some payments from the Chinese licensees came after the quarter end. So, from a liquidity standpoint, obviously there's not a imminent, I guess, going concern issue. They amended the covenants, so that's favorable as long as Halloween does come in and perform well. But withdrawing all guidance, excuse me, the continued high rate of share-based comp, the unwillingness to invest in the chief growth vector, and this obsession with spending money on this creator platform that has seemingly been dead on arrival for months now. Why I don't understand why they didn't simply find a partner, whether Patreon, whether Fansly, other, and license the brand out and focus on direct to consumer. I get the broad vision. I understand what they've kind of pitched in both private conversations with management and what they've said publicly. Right, you can understand the value of having all that data if you are the owner and operator. But then I think it gets back to just having eyes way bigger than your head. Thinking that you could successfully develop and create this product. Obviously, the gross misuse of capital in hindsight, based on what we've heard now, that this dream acqui-hire was really, you gave these guys who sold you something a whole bunch of equity, and now they're gone. And we'll see if there's any sort of clawback. I don't know. I'm speculating, but it's just a lot of disappointment after disappointment. But like you said, a lot that you step back and you try and not look at the management, and you look at the set of assets, Honey Burdette, the IP of the Rabbit Head. It's hard to think that the value makes sense, but clearly the market doesn't have faith in management, and I think it's safe to say my faith in management has declined further after today's call.
Obviously. I mean, still, even with this management team, I mean, just take a look at what they did with Playboy.com. I mean, if a horrible management team like we know they are right now did it, and I think you said that there are over 1,000 orders a day, average orders a day this month, something like that, right?
That was July, yep, during the promotion.
Yeah, so given my napkin math, I think there is a run rate of something like 30 million a year, something like that. They didn't do any revenue out of Playboy.com in 2020. And I mean, that's big. How big can this business be in 2023, 2024, 2025? How big can this be in 10 years from now? I mean, I know that Ben Cohen is not the right guy to take this brand and take this company into the next few years. But I still think there are some bright spots. And personally, that's why I still hold a lot of shares of this company, because I really do believe that it's worth so much more under the right management. And I mean, less than $6 a share. What is the enterprise value right now? Less than 500 million? That's a joke.
Well, joke's on us.
Yeah.
So somebody actually just gave me an order number from 2 days ago, so I'll share if the run rate for first week of August has fallen off. Do my basic.
We don't need any more bad news, Rod.
Yeah, just tell us if it's good, if it's bad. There's enough material to roast Ben on the Discord.
It's less than the full month of July rate was, but it's still up there. It's over 900 gross orders per day on Playboy.com from July 30th to August 7th. So, it's good to see that it's not fallen off a cliff. I don't know for certain if they extended the sale. I know it was supposed to run through July 31st. So if it's still holding up, even with them not, I know, for example, they are liquidating some things, right? We talked about the Big Bunny brand, sub-brand earlier, and that has been just a complete flop. And a lot of that merchandise is severely discounted, presumably, though, with how high the original MSRP was, because it was really priced as like you're talking about like puffer jackets for like $300. I'm sure the puffer jacket cost of goods sold is not more than, I don't know, $30, $40. So even if they're selling it for what, 70, 110, I think it is, they're still generating gross margin dollars, I think, on some of these severely discounted sales. But look, Playboy.com, obviously, as you noted, a lot, big improvement from being what it was before being monetized. I think if we try to look at bright sides, that's a big one. But no more guidance, no more aggressive growth. Apparently, we heard Ben basically say all costs are on the table. So now they're putting their PE hats back on to cut costs, all the costs that they just layered back on, seemingly. So
yeah, if I had to guess, he will close Honey Burdette stores before he will sell the jet, but I hope to be wrong.
Yeah, it gets back to then, a governance question, right? You have a private equity owner who's the chairman of the board, who has a share a shareholder rights agreement with the company. Who owns, will get, I guess, the most recent 13F filings in a few days for the laggards, but add his shares, Rizvi's, plus Ben Cohn's, plus Blant's. You've got existing management and PE basically owning close to a third of the company. So it's quite difficult to fathom there's much that can be done on the governance side, but who knows?
Yeah, I think there's a room for a shareholder lawsuit. If anyone knows a good US firm, let me know. And I would also like to know if they're planning to sue the Dream Team. And if they're not, there is also room for a derivative shareholder lawsuit.
Yeah, I was just about to say. So, what is it going to take for a community of retail investors? Well, I guess some institutions as well on Discord to oust the CEO. Has that ever been done before?
Yeah, we'll be honest. I don't remember the exact terms, but I think Ritzvi pretty much controls the board as long as he holds more than 50% of the company. I don't think that we have a true chance into making a big change in here, but maybe if other institutions that holds a large amount of shares will join us, we might have a chance to do something. And I mean,
just to be clear,
I don't think that.
Just to be clear, a lot. Again, you cut you off for a second. There's no group. There's no agreement, implied or otherwise, between Wook Capital and any outside entities.
There is no agreement. There is no agreement between anyone. We're just trying to know exactly how many shares are out of Ritzvi and Ben's control. No one is agreeing to do anything. This is not agreement. The form that I sent everyone, and we're just trying to understand what is going on and if there is a chance to change anything. I think there is a room to file an SEC complaint and to sue them, and maybe they will actually change things by themselves because they hold so much shares and they want to change things. I hope so. I don't think we can actually change anything with the current amount of shares we have, especially given the clause that says that Ritzvi controls the board as long as he holds 15% or 25% of the company.
I think it's with 15%, Rizvi can appoint the chairman. But I'm looking at Cap IQ and just
I think
really
also
quickly, I don't know if all of these data points are updated. Obviously, as I mentioned, some of the 13Fs need to flow in for the most recent point, but some of these are based on March 31st data, not June. But based on what I'm seeing, Rizvi, just shy of 24%. Fortress, about 4%. BlackRock, JP Morgan, Vanguard, that's another 9%. Then add Ben Cohen, and you're around 50%, right? So, barring something extraordinary, it seems quite unlikely. But again, anything is possible, as we've seen in markets over the last few years. And again, there's no group, there's no agreement, there's nothing. This is just a exploratory. I guess people are having a conversation about whether this is even a feasible route. I would argue it seems implausible from just glancing at the data. But yeah, I mean, it's frustrating when you hear shareholders, I think, that have been invested since the de-SPAC, many of whom have been in it for a couple of years now. And a lot of loss of faith in management. It's very disappointing, but I think a lot of that is self-inflicted and justified.
Yep.
But anyways, is there any more discussion around the quarterly result, around the going forward kind of expectations? Obviously we talked about Yandy. We obviously know Halloween is peak season. We're a few months out from that. I know I'll be very interested in seeing what the Playboy branded lingerie that is designed by Honey Birdette looks like, given how successful the Honey Birdette brand has been. I guess we'll be seeing that in a few months. I don't know. Any other thoughts? Anyone in the audience who wants to come up and share any thoughts or perspectives with regard to earnings or otherwise?
Maybe given the fact that the ND is accelerating for a year now, maybe in a few quarters, the growth rate should actually accelerate. I mean, Playboy.com is growing what? 60, 70, 80, 90% a year. Honey Birdette, something around 20 to 30%. Yandy is becoming nothing. Maybe the growth rate will be much better in a year from now, when the Yandy is pretty much nothing. What do you think?
It's grim. But yeah, not seen any other folks requesting to speak. And I think we've kind of beaten the horse to death, discussing the quarter and discussing some of the outlook. Yeah, I think I'm going to wrap it then. If I don't see any hands go up. Pause for a second. Buddy, if you had any last thoughts you wanted to share before I close us out?
No, I think we covered pretty much the gist of it. Honestly, a lot of build-up over the last few months of the negativity just to kind of get all our thoughts clarified. So I guess now it's just a wait-and-see game. Yeah, thanks for hosting the show.
Thanks, Rod. Thanks, everyone. Have a good night, and let's hope Ben Conman resigns the next week. Good night.
On that note, everyone have a great evening. I will be hosting a Spaces call after the close tomorrow with Jake Freeman of Freeman Capital Management to follow up on last week's Q&A that we had about FCM's plan for Bed Bath & Beyond. So just as an FYI, if anyone's interested, I'll be scheduling the space after we wrap. So thanks, folks, for joining. Buddy, everyone else who chimed in, appreciate the thoughts and the conversation. And as I noted, the call is recorded and will be available on Twitter for 30 days. So have a great evening, everybody.
See you guys.